Well, Myer says it has weathered the worst retail environment it has seen in 30 years. The department store managed to post a solid net profit of nearly $160 million, but retail analysts say that's been achieved by cutting costs. Kirsten Vaness reports.
Myer had many excuses to deliver a poor result for the year.
The impacts of floods and cyclones certainly been thrown at us, not only to mention a high degree of instability in the political scene. But our strategy is on track despite the worst conditions that I've seen in 30 years.
CEO Bernie Brooks says people simply aren't spending.
The highest saving rate that we've seen since 1983 at above 13%.
And that's being reflected in Myer's sales figures, which are down 3.8%.
We're actually seeing people deleverage, and consumers actually deleveraging and paying off debts, paying off the home, just getting that little bit of step ahead because they all got spooked really at the GFC.
But despite the gloom, Myer managed to post a net profit of $159.7 million for the year. It's more than double last year's profit, but that was mainly because of the one-off cost Myer had in floating the company on the stock exchange in late 2009. Leaving aside those costs, the profits are marginally lower this year.
In the current trading environment, we think that's a pretty solid result.
But retail analyst Rob Lake says the strong result has come at a cost.
Anyone who shops there can see that the service levels are not what they used to be and that they're falling further, and that Myer are doing this to save money, but they do it at their peril.
So have jobs been lost, or have they expanded and not put people on?
They've shaved hours and they've not replaced people, so that the number of heads on the floor has fallen.
Myer says that's not the case, that while it has restructured staff, including reducing numbers in its head office, it's working on improving customer service. Myer is also looking to revamp what even it admits is an average website, and it's reducing ranges that aren't performing as well, such as electrical goods. But already the 2012 outlook isn't looking that promising.
We forecast our profit could be up to 10% down. I mean, from the point of view of a number of headwinds, we've got $48 million worth of additional costs this year.
It suggests that they're still not increasing sales, doesn't it? And that they're running out of ways to get costs out of the business.
But Myer says it's prepared.
We've spent $600 million over the last few years getting our business ready to be able to react to volatile or uncertain or difficult trading periods, and that's exactly what it does.
Despite all the effort, spending is likely to remain low for some time.
I think it's another 12 to 18 months before it starts to really move forward and get stronger, and that'll be dependent on really about where the European macro issues are, the European crisis, the US situation.
For retailers, it's looking to be a very mediocre Christmas.